everyone. I'm JodieJo, the team lead over at the Sycamore team with eXp Realty.
Hello, Kahren Oxner, UMortgage. Happy to be here today.
Hi, ladies.
Professionally and successfully.
A good negotiation is when both parties get into a home with that assumable rate mortgage.
It's free to talk to us.
Yeah.
It's actually not a scary process
of finding the dream home. I really wanted to touch on the different possibilities in tapping into that equity on your primary or even an investment property residence, right? Because it's not just the bridge loan that's available and accessible to you. There are home equity lines of credit, which is the HELOC. There is a refinance option. So can you tell me what are the differences in regards to, say, the HELOC versus that bridge loan?
So it kind of depends on what your goals are, but an equity line of credit is a great option because they're not expensive, they're relatively quickly to put together and close. It allows you to access some of your equity. You can't access all of your equity, so we wouldn't be able to essentially pull it all out. But it is a really cost-effective way to solve that problem of just getting the equity so that you've got a down payment.
Mm-hmm.
However, conversely to the bridge loan, an equity line of credit you still have to qualify for as part of all of your liabilities. So you would have to qualify for the new house and the principal, interest, taxes, and insurance on the new house that we are proposing, your current house, including the principal, interest, taxes, and insurance on the first mortgage, and the new payment on the equity line of credit that you took out.
Mm-hmm.
So depending on your income and your other liabilities, that's going to be a larger amount that you would need to qualify for. But if you have the flexibility and the income to do it, it's a great option because it allows you to extract that equity very affordably and utilize it towards the purchase and still go non-contingent, which will make Jodie very happy.
Of course. Yes. Well, you said a couple of things in there that I kind of wanted to just tease out a little bit. One was an additional payment on that equity line of credit. So it does kind of essentially become like a mortgage,
mm-hmm.
right? It doesn't touch the first mortgage. So you could have, one of those lovely 2.5–3% interest rate mortgages on that primary residence of yours. So this is separate from that. It doesn't
impact that at all.
Impact that, at all. So this will have its own mortgage rate, correct?
Yeah, absolutely. So it leaves that first mortgage alone if you have one, and you don't even have to have a first mortgage to get a line of credit. It just simply is a vehicle that allows you to extract a certain percentage of your home's equity so that you can use it for other things.
Mm-hmm.
And maybe it's to buy an investment property, maybe it's to buy a new primary residence. Maybe you are going to buy your new primary residence and keep that. So now you'll have your 2 homes. Maybe you'll keep that and decide to rent it out. So it just gives you the flexibility, assuming you can qualify for all of those payments,
mm-hmm.
versus a bridge loan that you don't have to worry about qualifying for that,
right?
For that piece of it.
Right.